This is Natalie Pace, and I am pleased to be bringing you my friend. I've known him for a great deal of time, and also large cap value expert, Kelley Wright. He is the managing editor of IQ Trends, Investment Quality Trends, iqtrends.com, and the author of Dividends Still Don't Lie. So we'll be digging into his picks, his lucky 13, what his strategy is, even his crystal ball for 2023, because even though he focuses on large cap value and has a real strategy for that, he is also very astute on macroeconomy too. So we'll get started shortly. Remember, you can share this. It's free with your friends. And it's always available at youtube.com/Natalie Pace. You can just scroll through the videos and find it easily. Or if there is an interview, you know I did, but you can't find it, just email us, info@nataliepace.com, with the interview you are interested in the subject line. Thanks for joining us. We'll get started momentarily. All right, Kelley, I really want to know if you polished up your crystal ball, and if so, what are you seeing for 2023?
You know, I think it's going to be a little bit of a meat grinder, to be honest with you.
Okay.
For lack of a better term.
Well,
I think the easy part of the froth that had built up, was taken off last year, and I think that was the easy part. And yeah,
right.
we've been enjoying this little bit of a rally, which is, I don't know if it's the typical rose-colored glass type of a thing that happens at the beginning of the year. Could be, all of the 401k and IRA money, that hits the beginning of the year. They got to put it to work. Blah 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 quack.
Well, also that 1Q just came in this morning at 2.9, so everybody's all excited about that, right? So 4Q, the 4Q and full year, 4Q 2.9, full year 2.1. So they're like, oh wow, we're doing much better than we thought. Everybody was saying we were going to be in a recession last year, and here we grew 2.1%.
Yeah, we're rocking, we're rolling. Yeah, GDP was good. I think if you look at the 10-year, 3-year, I forget what they call it. There's a fancy name for it. It's only signaled 8 times, and it's 8-0 for a recession. So,
the yield curve. Yeah. Yep.
So, look, this could be the year that it goes 8-1, but I don't think that the increases have fully flowed through and hit all the way yet. I mean, we're seeing it in different parts of the economy, but housing's always the long, slow, last thing to kind of roll over. I mean, we've seen different parts of the market have gotten hit, bada boom, bada bing, up, but I also noticed, the layoffs, particularly in the tech industry. So, there's stuff that's still filtering through, but I think this early part of the year, rally notwithstanding, we're not done yet.
Well, also that kind of leads me into your area of expertise, which is debt and leverage. Look, everybody that had a pulse got money in 2020, including all the corporations, right? So are you at all concerned about both debt and leverage? And then we'll talk more about valuations. We talked about some of the frost being off, but let's talk about the debt and the leverage first.
Geraldine always used to say that debt is the albatross that hangs around your neck. Okay. And a lot of that debt was acquired, yes, at lower rates, but some of it's been rolled over, some of it's been refinanced. It's going to be tougher to carry it. Okay, especially if earnings get compressed. So and leverage is a double-edged sword. Leverage is great at the bottom when things are starting to turn and go back up. That's when you can really, pedal to the metal and go crazy. Yeah, when we're in a rising interest rate environment, though, and an economy that is agitating to slow down, yeah, uh, I think you got to be careful.
Okay, so let's talk about how careful looks to you. What would you in general say? And let's also extend that, because I know that you're a father. I really I'll be and admit it. I already said what a huge fan I am of you. I think you're just one of the greatest guys I know. I love your brain. I love your heart. So let's talk intergenerational wealth. Like, what do you think is one of the most important things for someone your age to do? And also, we're seeing with the kids and their college loan debt, and a world that doesn't really add up for them in their budgets. What do you think they should? I mean, obviously, I'm asking a soundbite here, and we could talk about this for days, but what do you think in general, your generation versus your kids?
Well, my generation got a huge generational transfer. Okay. Now, that was an entirely different mindset from that generation prior to mine. A lot
Yes.
of them were influenced by, the Depression, and they were much more prudent and, even skimpy, if you will,
Yeah.
my kids, and look, I'll be honest. I mean, I've spoiled the hell out of my kids, because I didn't want them to go through some of the same stuff that like my grandfather did, and that I did. So I've always told them, don't dig yourself a hole when you're young by piling up debt.
Yeah.
And if you've got college debt, look, pay it down, pay it down, pay it down. Look, your big earning years are ahead of you. Okay. And when you get into your big earning years, you want to put that money to work towards when you start getting towards my age, you start getting to retirement. So is it fun? No. Do people like to do it? No. Does it take discipline? Yeah. But do the discipline now, pay down the debt, get it off the books, get it out of your way. Because then as you move up the ladder and you start getting into your core earning years, then you've got that money to put to work towards more positive things than debt.
Yeah. And passive income, money while you sleep.
Yeah, yeah. Money never sleeps. So yeah, passive income, whatever you can do to get yourself in a position to start. Look, investing is very simple. It's about return on investment. It's about building capital from resources other than your paycheck. Okay.
Yeah.
So you want to get your impediments and things out of the way to clear the deck so that you can grow your wealth. That's the reason why we do all this, is to grow our wealth.
Exactly. Okay, so let's talk about our generation then, because if we're heading into a meat grinder of a year, how
Yeah.
do we protect ourselves? Because as we all know, been in this industry long enough, market timing doesn't work. Because if market timing, we would have thought last year we were going to be in a recession when we had those first 2 quarters of negative growth. So
Sure.
market timing is not a good strategy. Maybe being all in, even on your index, which outperforms the S&P, might not be a great idea if you're age 60 or older, or maybe even age 50 or older. What would you do? Or what would you say to people that are closer to retirement?
Okay. So this in part gets into how the way that you're wired.
Yeah.
Okay. We all have a pain threshold. Okay. I think the most important thing that all investors can do is, first off, is know yourself. Know who you are. You have to have a philosophy about investing that you can live with. I talk to people all the time about the pillow test. If when your head hits the pillow, the last thought on your mind before you drift off with the Sandman is your portfolio, you probably have too much risk. Okay.
I like
So
that.
you've got to know who you are. And then there's so a lot of people, they think, oh, I can handle X decline in my portfolio.
They always think that when the markets are hot, though. They never think that in the apocalypse.
Until your butt is in the frying pan and you can feel the sizzle, that's when you find out what your risk tolerance is.
Yep.
So,
yep.
Yeah. So know yourself and understand what risk means to you. Okay. There's a difference between being in a high quality company that might temporarily be down because of something ancillary that's not fundamentally wrong with the company. It could be just, the market's in a correction. Okay.
Yeah. Yeah.
But if there's nothing fundamentally wrong with your company, and the cash flow is fine and the dividends are safe, you can withstand a quote unquote paper loss, a paper decline, but a loss isn't a loss until you take it.
Right. That's an important thing. All right. So let's talk a little bit about valuations, and then we're going to move on to your lucky 13. We don't have to spend a lot of time here because you said essentially the froth has been taken off, which means that maybe you think it's still a little pricey. If we looked at Warren Buffett's favorite pricing tool, it's really outlandishly pricey. And, Shiller's CAPE ratio is very high as well. So what do you think about valuations? Actually, when I was looking at some of your lucky 13 picks, their price earnings ratio is better.
My universe is going to be typically, you're going to have a lower PE because, my universe
lower
is,
growth.
Yeah, it's super high quality dividend paying blue chip stocks. Okay. Yeah. It's not the go-go, it's not the fangs, it's not, the hip, slick, cool, sexy stuff that everyone, woo, mine is
a lot of fun when it goes up.
A lot of fun when it goes up. Yeah. So there's, Natalie, there's the valuations of the broad market.
Yeah.
And then there's, Geraldine always used to say, there's the stock market and then there's the market of stocks.
Yeah.
And those are two entirely different things. And what we're concerned about is the market of stocks that meet our criteria and that represent good value based on what their current dividend yield is versus their history. I talk with my hands, sorry. Versus
that's good. We like that.
Their history of dividend yield patterns.
Yeah.
So the market can be look, if you're talking about the broad market could take a 50% hit, and on a historic valuation measure, it would just be still ho-hum garden variety middle of the road valuations. That's if the broad market took a 50% hit. So,
and by the way, we both know that that's what can happen in recessions, right? I mean, we were just on that panel last week and we're saying, look, it was 55% down in the Dow in the Great Recession, 78% down in the NASDAQ in the .com. I mean, people have to be aware of the potential out there, especially like put yourself in the frying pan before you're actually there. Yeah,
because if you haven't thought about it and then you find yourself there, you're going to react negatively and you're going to hurt yourself.
Yeah, but you'll sell low.
Yeah, exactly. And the thing about extremes, about excesses, is that and this bull market that we had was fueled by easy money and
financial engineering,
crazy environment. And so the pendulum swung really, really, really high on valuations.
Mm-hmm.
Now, historically, when that pendulum swings back, it typically goes to an extreme as well.
Yeah, it's a bloodbath.
Yeah, and overshoots to the downside. So when we look at stocks and when we're buying, even if the broad market is overvalued, we're buying stocks that are at their low point in terms of price and high yield. So our stocks have already gone through their own
bloodbath.
Yeah. So when we buy, we feel good about it. We know that we've bought at a good point, and we can withstand we can withstand bad things happening in the broad market. So
yeah. Well, I want to just, you've been making reference to Geraldine Weiss. So I just want to real quickly put this in context for folks, is that Geraldine developed, I believe it's a 6-point, strategy looking at things. We call it stick to your knitting. And I would say that Kelley sticks to Geraldine's knitting in a way that really honors her legacy, and obviously has earned him quite a legacy himself. So again, those people that are interested in large cap value, you want to go to, it's iqtrends.com, right?
Correct.
All right.
Yeah.
So
Yeah.
I know you don't want to get into all of your picks because they are proprietary and you have a newsletter to sell. But can you give us one or two on your lucky 13 that you really like, maybe your two favorite, and tell us why?
All right. I really like Amgen. It's a biotech pharmaceutical because we still have an aging population, but that part aside, that macro part aside, if you look under what we call look underneath the hood and you look at their cash flow internals, their return on invested capital is very high. It's like 19%. That means for every dollar that they've invested in the operating part of the company, they're getting a 19-cent return. Their free cash flow yield, which is free cash flow, is just a really fancy name for profits, but nobody uses profit anymore. So you take the enterprise value, what's the company worth, and you divide it by the free cash flow, and you get what's called the free cash flow yield. It's a much better metric than PE ratio. So their free cash flow yield is 7%, which means that they're rolling in the dough. And they're at their high yield area, and they have this amazing track record of increasing their dividend at least 10% a year for the last 12 years in a row. So that's something that we really, really, really like. Yeah. All right, so there you go. Let's look at West America Bancorp, and the symbol is WABC. So this is a regional bank. All right, now going into a recession, if you're thinking about a bank, you're thinking, God, you've lost your mind. But okay, 12% return on invested capital, free cash flow yield of 17%. Okay, so those are numbers, all right, and they're at their low price, high yield area, but they are extremely stingy about who they loan to. I mean, you have to be pristine. Okay,
you don't need the money; they'll loan it to you.
Absolutely, if you need it, you got to head down the road. And also a super majority of their deposits are from businesses. And so that's money that sits there basically. You're talking about checking accounts. And so they've got this huge base that they pay nothing on, and they make more money investing in securities than they do in lending or in real estate or anything like that. So just exceptionally well-run bank. And they're up in the Northern California kind of area. But yeah, like them a lot.
Great. All right. So we've talked about a few here. I wanted to ask you about something. I noticed that 3M was on your list, and this is just getting, again, more into looking in the crystal ball down the road. We just heard an announcement that they are going to end Forever Chemicals, and probably the reason for that is they've been sued and they may have up to like 30 billion in legal liabilities. They make about $6 billion a year. Does your system account for anything like that, where there may be, I know you have Philip Morris on there. So was there a point where Geraldine or you said, hey, this is an industry right now that looks good on paper, but what I'm seeing in the crystal ball headed down the road may be some headwinds that are less comfortable?
Yeah, look, life happens. And, tobacco is a little bit different industry because human nature hasn't changed a lot since the Garden of Eden. People like stimulants.
We have a lot of pleasure seekers.
People like their stimulants. They also like their barbiturates, so thus alcohol. Back in the day, my grandfather used to call them the sin stocks. And another friend of mine used to say, sin is in. How do you spell sin? F-U-N. So, tobacco's got a fresh new crop
sadly,
of customers every year. 3M, they've got some pain. They've got some pain. For us, the writing on the wall is going to be if something happens to their dividend policy. Okay.
And that may happen if they have net losses or have to take it. They probably won't take that 30 billion in one lump sum. So that'll be spread out anyway, and they'll fight it as long as they can while they clean up and all that. But yeah, you're probably right.
They'll try to inflate it away.
Yeah. Okay, so any lessons that were learned from General Electric in terms of how, I mean, we both were joking how Warren Buffett magically managed to sell all his GE stock about 4 months before they cut their dividend in half, and then now it's trading down at a penny.
Yeah, just gosh, how lucky can you get? Okay. You remember back in the day, I remember Geraldine saying, as GE goes, so goes America, which just goes to show you that even, great companies are run by human beings with nervous systems, and they make mistakes. And GE lost their way. It's very simple. They got away from what they did best. AT&T is trying desperately to join that club. That's another one.
Yeah.
I mean, they've got one of the most marvelous franchises in the world with their wireless business. My God, just stick to what you do so well. Instead of, so
HBO Max. Well, listen, I mean, I loved a couple of things you were saying there. First of all, I just got a notice from Howard Silverblatt that they're booting AT&T out of their S&P Dividend Aristocrats list. So is it still on your list, or have you given it the boot?
About 2 years ago, when S&P dropped their quality ranking from a B plus down to a B. Quality ranking is one of our 6 criterions, and you have to have a B plus or better to stay in our universe. Right. So AT&T is in what we call the faded blue chips. Those are stocks that used to be in our universe, but either because their quality ranking got lowered below B plus, or they didn't meet their earnings or dividend growth parameters. So we haven't looked at AT&T in a long time. Verizon's another one. They're in the faded chips, So these companies that were founded, I think, if they were founded before 1980 and they had pensions, OPEBs, and that such thing, they may have the more debt. All right. Any last words of wisdom from you, Kelley? We're all ears. Wrap us up. Okay. Investing is a business. It should be treated as a business. It's not a casino. It's not a lotto ticket. Okay. If you were going to go buy a business down on Main Street, what's the first thing you want to know is, how am I going to get paid? Okay. So when you're buying a stock, you're buying an ownership interest, and you want to know, how am I going to get paid? What's my return on investment? And that's, I think, the most important thing that you can do is know how you're going to get paid. And then that's, dividends are the most immediate example of return on investment. And that's why we're such dividend advocates. But other than that, know who you are, have a philosophy, and stick to it.
And I want to circle back, because I wanted to kind of highlight this. When you were talking about Geraldine, and she has an extremely great track record, her system, you do. Nobody is 100%, right? So we also have to recognize that. And, I always liken it like the beautiful woman that sees only the zit on her face. She's leaning into the mirror, all she sees is the zit. And, if she just looked back and saw herself the way all of us see her, she would see this beautiful woman. And so, have a plan that doesn't look, where you don't expect yourself to be perfect, right?
Well, look, if there was a perfect system, the market would cease to exist because everybody would adopt it and the market would go. It would go.
Communism.
There's some fundamental, I think there's some fundamental things you can do. I'm a big believer in fee-based financial planners, not, financial planners that necessarily are product people that,
Right.
do a plan by, okay. So there's certain things that you need to understand. Know what your budget is. know what you're spending money on, when and where. Okay. And then, you need to have a retirement budget. And look,
Yes.
some of us are butchers, some of us are bakers, some of us are candlestick makers. And if you need help with this, there's people out there, and they're worth the expense, they're worth the time to help you get organized, to help you get disciplined. Then once you know what your financial picture looks like, okay, you do a really good job about this. You're more into allocation and looking at the whole picture. I'm just looking at the equity part because that's where we live. But when someone comes to us, I assume you've done all of that work, and now you want me to help you with the equity portion.
Right.
But you need to know all of that stuff. And life insurance, health insurance, these are important things, especially if you are responsible for providing for the needs of someone else. Okay.
Yeah.
What if something happens to you? You need to have a backdrop, for a safety net. Okay.
Yeah.
You talk the best about safety, I think, of anyone out there. I assume that it's been done. But people need to be reminded. I have 5 children,
Yeah.
So
these things are things you do yourself. You're telling them what you do yourself. And this is something I really am grateful, because before, when I led into you, I said, look, this is Kelley. He's a large cap value guy, right? And I think that's important, is like, you don't want to use Kelley's tools, which are amazing in his area of expertise, and think that you're using it to protect wealth. You're using this to grow your wealth and to take on that extra little bit of risk for added performance. And again, you can brag about yourself here, because I do know that your performance is better than the S&P 500. So those of you that think, I'll just put S&P index in my large cap value, you might be missing out by not checking out what Kelley does. And do go to iqtrends.com. Kelley, as always, we'll have to do this again. I really, really admire you. As you well know, I'm a super fan of you, and I'm very, very grateful for you joining me today.
Yeah, it's always a pleasure. I'm at your service anytime. You're one of my favorites. And I think what you do in terms of education and helping your folks, it's absolutely necessary. She's one of the good people. All right. She's one of the best in the business. And what you do is very, very important. So I am a big fan of yours.
Well, thank you. Thank you. Appreciate it. All right. So hopefully we'll get a boatload of people over there learning from your expertise. I'll see you at the next Money Show, and have a lovely weekend.
All right. You do the same. Always good to see you. You take care.
Okay. Bye now.
Bye-bye.
All right, everybody. And thank you for joining me today with Kelley Wright. Again, he has a good system. It was developed, almost 40 years ago by his predecessor. And also, he is keen on making sure that you understand how to use his tool. And he's a good man. So I hope that you take all that he says and visit him, especially if you're interested in large cap value. For those of you that know me as the author of The Power of 8 Billion, It's Up to Us, and also as Put Your Money Where Your Heart Is, I will say that if you choose to invest in that way or get a large cap value fund in the US, you are investing in a lot of polluters. So if you're interested in putting your money where your heart is and making sure that you're greening your portfolio, there's another thing too, and I have talked about this both in video conferences and in blogs. ESG investing is missing the E. Value investing in the US missing the E as well. So you may be profiting from polluters. So if you are really keen on this, on healing our planet, not only in your product choices and changing your consumer behavior, but also in greening your portfolio, it's not as easy as just going with Kelley or ESG investing, but it isn't difficult once you learn it. So reach out to us. That's what we do here. You could start with reading The Power of 8 Billion. It's up to us. Also, I would encourage you to attend our next online retreat, which is going to be in April. If you register by January 31st, you get a free coaching session and the lowest price. Also, I'm going to put a few blogs in the, in this video conference so that you can easily access them. This one is 10 Wealth Strategies of the Rich. So as you can see here, large cap value is a piece of our pie, not the whole banana, okay? Also, there's a rebalancing your nest egg IQ test that I recommend anybody, especially over the age of 35 or 40, to take. This will be in there. And I also have an investor IQ test that I just posted with updated data. And that's right at nataliepace.com/blog. So again, thank you so much for joining us today. And you can watch this back at youtube.com/NataliePace. Share with your friends. And I'll see you in February. I'm going to be hosting Howard Silverblatt, the senior index analyst of the S&P 500. He'll have a lot to say, words of wisdom as well. Thank you again, and see you soon.